Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending April 10th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. It has been a busy week. A ceasefire between the U.S. and Iran sent oil plunging more than 12% intraday, with WTI crude falling below 95 after trading above 112 just a day earlier. Stocks surged, yields dropped, and the mood shifted fast. But the macro calendar is stacked. February PCE comes out this week, along with March CPI and Michigan sentiment, and these are the first inflation prints that capture the energy shock. Heading in, Wall Street was bracing for headline CPI north of 0.8% month over month, which could push the annual rate above 3% for the first time in over a year. Last Friday's jobs report added another wrinkle, with 178,000 jobs added versus roughly 60,000 expected, though nearly half of that was Kaiser Permanente's workers coming back from a strike. Wages cooled to 3.5% year over year, and Fed funds futures are pricing in essentially no rate movement through the end of 2026. And then layered on top of that, Jamie Dimon's shareholder letter warned about geopolitical risk and regulatory dysfunction, while we're also starting to see signs of pressure in parts of the private credit market, with rising redemption requests and tighter liquidity dynamics starting to emerge. So on today's episode, we'll unpack it all and explain what this could mean for CRE, and we'll also dig into the latest CMBS issuance data, including signs of strength in the office market, and walk through a 101 on valuations and appraisal reductions. We'll also share several of the latest office headlines and discuss Bed Bath & Beyond's buying binge. Stephen, I know that is a lot to unpack. What are you starting with, and what are you watching most closely?
Well, first, I'm watching out for the truck. I don't know if you heard it, Lonnie, but that beeping sound was the headline truck backing up. I mean, this has been a lot to digest, and that's kind of been the go of it every single week for the last couple of weeks, honestly. So for me, this week really comes down to one question. Does the ceasefire actually change the inflation trajectory, or did the energy shock already leave a mark that's going to show up in the data regardless? And I think the answer is the damage is probably already in the pipeline. So look, oil came back down fast, and that's great, but WTI spent the better part of 2 weeks above 105 and 110, and ultimately that feeds into transportation costs, input costs. Ultimately, we'll see some impacts on maybe even shelter and services with a lag. I think, honestly, the forecast from a number of different folks that I've heard on the street is for oil to hover around 100. So even if oil stays at that 95 to 100 level from here, the February and March prints are going to reflect the run-up, not the reversal. And if we do see a headline CPI print above 3%, that's this week, that's going to be a psychological threshold. And it changes the narrative from inflation is grinding lower to we're reaccelerating and the Fed has to respond to that narrative, even if they believe it's transitory. Now, the jobs number is interesting because at the surface, it looks hot, but Haley, like you noted, when you peel it back, it's really a Kaiser story. When you strip out the healthcare, the return to work effect, and you're really looking at a much, much softer print. But the market doesn't necessarily parse it that way in real time. And the headline number gives the Fed cover to stay on hold. And that's exactly what the futures data is telling you. There's really not a lot of hope for cuts through year end, even if some folks are talking that up. So that's the world CRE borrowers are living in. And then, as you mentioned, the Blue Owl story is one that I think deserves more attention than it's getting. $5 billion in redemption requests from a major private credit platform. That's a liquidity signal. And we've been seeing that for, weeks, months. Just for fun, I went and used a LLM, one of the major chatbots, and I asked it to harvest the major companies that have shown up in the headlines. You got Blue Owl, Cliffwater, Ares, Apollo, Barings, Morgan Stanley, Blackstone, Goldman, BlackRock. I mean, it's amazing how many folks have shown up in the news. And honestly, that in a way, it's maybe good for commercial real estate. And I think we've maybe seen that in the CRE CLO sector through the first part of this year. So that doesn't mean that the sky is falling, but it does mean that allocations are shifting in certain parts of the market that were priced for a soft landing and low vol. So if that redemption pressure spreads, it will have implications for CRE capital availability, maybe even in a good way, and particularly in that bridge and transitional lending space where private credit has been a huge source of liquidity. So to say it another way, the CRE CLO issuance we've seen so far this year, I think, is probably in part a signal of some of the capital flows shifting away from private credit back into our space, which is great to see. So to bring it back, I'm watching the inflation prints tomorrow to see whether the energy shock left a fingerprint, watching the Fed reaction function, and I'm watching private credit flows for any signal that the liquidity backdrop is shifting underneath us.
That's a pretty full slate of things to watch, Stephen, but I think those are all valid things to be keeping an eye on. I agree with you. If inflation goes over 3%, I think it changes the narrative for just the way people look at that. It's a psychological barrier. I don't know necessarily that something above 2.5 is substantially different than 3.0, but the psychological barrier will have been broken. And we've seen that with the treasury yields too. When they get close to 5 on the 10-year, things start to slow down. And so it'll be interesting to see how and what gets reported on that. I think the job stuff that you mentioned, you just got to dig a little bit below. And that's kind of the theme we've had heading into 2026 is you can't just look at the headline numbers on some of these things. The oil stuff is very interesting. And like a 2-week ceasefire doesn't really mean anything. Right. But these things have all priced in now as if we've got some resolution. I think a 2-week ceasefire is completely different than some sort of agreement or memorandum of understanding or pact or whatever you want to call it. This effectively just is 2 weeks. And hopefully within those 2 weeks, they can reach something that's more permanent as a solution. But I think oil prices and other things are very optimistic given what we saw yesterday in the markets. And so I still think this is going to ebb and flow. I think this is going to be similar to what we went through with the tariffs, where there was kind of a wait and see approach. I think people are optimistic, but I wouldn't be surprised if we get another 2-week extension or a week extension or maybe a 30-day extension to a ceasefire where they try to work things out. Hopefully that's what happens. The private credit stuff is very interesting. I mean, we've seen kind of a rotation from some of the traditional corporate credit stuff into CRE, and you mentioned the CRE CLOs. I looked this morning, I think we've had 16 deals or 16 deals come to market this year already. So it's been very active. I think there's still going to be a lot of opportunity for the private credit markets, but maybe they just funnel money back into the CRE space, which could be good for the CRE, the market, as you mentioned. So I think that's something I'll definitely be keeping an eye on because we've seen a resurgence in that space in 2025, and thus far in 2026, it's on pace to do even more.
So Lonnie, you mentioned oil and we've talked about treasuries. So let's merge these two together because I love economic history and I think this is some interesting backstory here. So if you haven't heard of it, let's just briefly walk down the road of the origin of the petrodollar system. So after Nixon ended the gold standard in 1971, the U.S. needed a new mechanism to sustain global dollar demand. A 1974 deal with Saudi Arabia established that oil would be priced in dollars in exchange for U.S. security guarantees, and other OPEC members followed suit. So that created what's known as the petrodollar recycling loop. Oil exporters plow dollar revenue back into treasuries and U.S. financial assets. So one of the things that I've heard come up in some commentary out there on the street is concerns about maybe potentially some damage being done to that petrodollar recycling loop. In other words, if a lot of oil now starts getting priced in other currencies, does that do some damage to US dollar demand, the strength of the dollar, and ultimately result in higher treasury yields? Now, I think we're a long way off from seeing that yet, but the fact that it's even being discussed has me just a little bit concerned. But I don't know, am I thinking too far kind of off the road and down the road here? Or is this something that maybe concerns you a little bit as well?
Look, I think given where we are, I wouldn't take anything off the table. And as we've seen, both with the implementation of tariffs and some other things on the global scale, things that were implemented 100 years ago might find their way. It's kind of like, fashion. Things that were fashionable 20 years ago find their way back into fashion now. Maybe this comes into play at some level. I probably would say I don't think we're quite there yet. I mean, for all of the instability we've had over the last couple of weeks, we didn't see $200 or $300 a barrel oil prices. You know what I'm saying? Like it's outside the range on a typical scale, but it's not some multiple. So unless we get to something that's just completely way out in left field, I think things will settle themselves down and we probably won't have to revert back to some of the stuff that was implemented in the 1970s.
I'm with you. I think until we start seeing more headlines in real time show up about, oil not being priced in dollars, I'll feel okay and continue sleeping just fine at night. But if you are interested in going down that conspiracy theory road, just Google petrodollar war theory. You'll find some pretty interesting commentary about U.S. geopolitics and the history of, anyway, some Middle East confrontations. But that was something I thought was maybe worth bringing up because I've heard it a couple times, not just related to the Iran war, but leading up to this about just generally de-dollarization. I think we even talked about on the podcast a couple months ago. So the fact that it's come around again, just something to keep your finger on the pulse of, even if it's a weak pulse.
So let's go back to something we chatted about earlier, but I want us to look more deeply into Jamie Dimon's shareholder letter that came out this week. He warned shareholders of mounting risks from geopolitical conflict, AI uncertainty, and what he described as flawed bank regulations. So let's walk through any takeaways from this letter. And then we hosted a bank webinar last week where we had some very similar themes that we were reflecting on when it comes to the bank market and some of the key risks we're watching.
Yeah, I'm not sure if Jamie was joining that webinar and pulling some notes from our own Andy B, or if Andy B was writing Jamie Dimon's letter, because there was exact overlap in the topics, which I love. Right, that's a reason you should be joining the Trepp webinars. Is you get that intelligence in real time, sometimes beforehand, before it becomes mainstream news. So Jamie Dimon's shareholder letter warned of a couple mounting risks, and the three big ones they honed in on was geopolitical conflict, artificial intelligence uncertainty, and what he described as flawed banking regulations, which were the exact same three that were talked about in the Taller webinar a week before. So among the threats that Dimon placed front and center, the conflicts in Ukraine and Iran, instability across the Middle East, and accelerating tensions with China create a very tenuous landscape. So he said, quote, "The outcome of current geopolitical events may very well be the defining factor in how the future global economic order unfolds." So he said, basically fighting Iran, Dimon argued, could ripple through the energy and commodity markets in ways that push prices higher for longer, in an outcome he suggested bond and equity markets have not fully priced in. Those ongoing trade negotiations added to the uncertainty. According to Dimon, he said, quote, "The trade battles are clearly not over, and it should be expected that many nations are analyzing how and with whom they should create trade agreements." So the U.S. trade policy, Dimon noted, is redrawing the map of global economic relationships. A reshuffling, he conceded, carries legitimate grounds in national security, even if long-run consequences remain impossible to forecast. Turning to regulation, Dimon acknowledged that post-2008 reforms had merits, but argued they ultimately left behind a system he characterized in his own words as fragmented, slow-moving system with expensive, overlapping, and excessive rules and regulations, some of which made the financial system weaker and reduced productive lending. As CNBC reported, Dimon offered a guarded verdict on regulators' latest version to the Basel III Endgame and GSIB surcharge framework, telling shareholders his overall reaction was mixed. While the proposals reduced capital requirements compared with the 2023 versions, there are still some aspects that are frankly nonsensical, according to Dimon. At the proposed combined surcharge level of roughly 5%, he wrote, JP Morgan's required capital buffer on most consumer and business loans would exceed what comparable non-GSIB lenders must hold by as much as half. A disparity, he quoted directly, as much as 50% more capital across the vast majority of loans to U.S. consumers and businesses when compared with a non-GSIB bank for the same set of loans. He called that outcome, quote, un-American. That's pretty strong phrasing, Lonnie.
You know, it's interesting for some of these CEOs that become household names, right? They love the shareholder letter because it talks about their business, but it really gives them a chance to kind of just say whatever they want about whatever they want. And then the media loves it. They pick it up and it becomes this huge, event. I think, we've said on this podcast for some time, and I still believe it, people just talk their book. And listen, I think some of the points Jamie Dimon makes here around geopolitical conflict, artificial intelligence, bank regulations, valid. They probably have some significant merit. But I also think some of this stuff is just a bank CEO talking about how and why they think the system is unfair to them and how and why they shouldn't have to comply with certain regulations and how it's not in the best interest of the system to continue down this path. Look, good on him for putting himself out there. I think it is good for the system to have people like him speak out when they think something is unfair or something is, as he says, un-American. He should use his platform to try to be a catalyst for change and bring about regulations that maybe do level the playing field. But at the same time, look, they're doing just fine. JP Morgan Chase was gifted some of these insolvent banks, and there's been a lot of favorable things that have gone their way. And so, it's good for discussion. It's got us talking about it. I'm sure it'll have a bunch of other people talking about it. I do like the fact that our banking webinar last week, kind of front ran some of these topics. It highlights how our subject matter experts are plugged into the market dynamics. Good on him for putting it out. Great for us talking about it. I hope a lot of other people that maybe have some ability to make some of these changes talk about it. But what I'm confident of is tomorrow we'll wake up and there'll be a whole nother slew of headlines that we need to cover on our show.
That's what keeps us in the seats. So since we covered mostly just what was coming from Jamie Dimon's letter, let's turn to some of the takeaway themes that were talked about in the taller webinar, since I'm sure there were plenty of our listeners out there who were not able to attend. So this is going to be only just a brief cross-section of some of the topics that were discussed. So first up, one of the things that was talked about is, quote, a new CRE cycle that has become evident with growing origination volume at tighter spreads, while legacy troubled assets have pushed delinquencies higher. And of particular interest, you can see that extensions remain the primary risk management tool in our banking data, albeit with extension quality deteriorating since the rate tightening cycle started. So one of the interesting things you get to see with this bank loan level data in our taller data set is both what's happening with these loans and the credit migration and also restructuring. So you get to see those loans getting extended and their new credit risk ratings. Also of note, new construction lending remained predominantly in the multifamily sector, suggesting that lenders are confident that the supply wave has crested and rent growth will accelerate. Now, legacy multifamily construction loans tend to be rated roughly one letter grade lower than an equivalent income-producing loan, as lease-up and rent likely did not meet the underwritten plan. Now, turning to the C&I side, overall C&I portfolio quality remains stable, although a recent increase in 30-day delinquency and downgrades in AI have impacted industries and it suggests future portfolio deterioration. So that's something we're definitely going to be keeping our finger closely on the pulse of, is how some of the ultimately value and credit destruction the software industry plays out. We all know, I think a lot of it has been overhype, but there's definitely some real migration happening that we need to keep track of in real time. Now, banks are downgrading AI-impacted industries. So you're seeing that come through as a higher concentration of low-rated credits are being downgraded in professional services, while banks are downgrading credits to information firms across rating grades. And then finally, turning to some of the private credit topics here, although recent headlines highlight specific liquidity situations at select private credit funds, bank ratings and reserving suggest minimal credit concerns at this point. Banks tend to lend more to limited partners than the funds themselves, also limiting risk. Now, that being said, bank credit to private credit funds tends to, quote, jump to default, which requires active collateral management and also inviting regulatory questions when that jump does occur.
Yeah, Stephen. So on this, I think a couple of things that I wanted us to maybe dive into a little bit is just when we say the divergence is worth watching, like aggregate CRE lending momentum appears to be stalling as caution replaces optimism, and CNI and NBFI, so non-bank financial institution lending, continue to grow. Couple that with the private credit stuff that we just talked about, where maybe some private capital, private funding comes into the CRE landscape, which we probably view as a net positive. The timing of this is positive if banks are pulling back even more. But what does this really mean? I mean, like if that caution turns into reality where people are still pulling back, I mean, I think 2026 was predicated on this optimism that banks were going to get back in the lending space and we were going to see more competitive pricing and another option for borrowers. It sounds like it maybe isn't going to play out that way this year.
It's definitely framing up that way, that there's a strong potential for us to take like 1, 2, 3 steps back here, but it's not baked in yet. So why I say that is if you look at primary and secondary CMBS spreads, and look at their movement for this current event, the Iran war, relative to prior events, like say Liberation Day, COVID, the Russia-Ukraine war, the jump in spreads was not quite as dramatic, and the pullback was, to me, at least looking at the data, it looked a lot more confident than what I would have expected if this were expected to be a persistent negative shock, persistent negative hit to growth. So the fact that we have snapped back so quickly and by that amount gives me hope. Hope is not a strategy, but at least it's providing me some comfort.
Even with inflation potentially ticking over 3%, like, do you think that that has any implication or ramification for some of these bank lenders?
They're definitely going to be concerned about it. I mean, the question is, how long does it persist? And I think that's where, like, the likes of Jamie Dimon, when they say it's not fully priced in, I suspect that's where a lot of that conviction and that commentary is coming from, and that they're thinking markets have really underpriced the persistent hit to inflation and what that's going to mean for consumer impacts and a reduction in growth.
So going back to our bank data, if you're not familiar or you haven't heard us talk about it on the podcast, I wanted to do another quick plug for our Trepp anonymized loan level repository. A lot of people in the market think Trepp is only synonymous with CMBS, and that's not the case. While we do have the most trusted and robust CMBS data out there in the market, we also manage a consortia of bank data, and that's what this taller data that we've been talking about is. We have just unveiled new ways to get access to this data via interactive dashboards. So we now represent over 180 billion in outstanding commercial real estate and 345 billion in outstanding corporate bank loan data. You can get access to it via data feed, via dashboard, and in so many different ways. So if you're interested in seeing a view of our bank loan data, looking at the market intelligence, getting insights into construction lending and peer benchmarking, reach out to us. We'd love to showcase this data set to you and give you some insights from our consortia.
And we do custom advisory work using some of that data too. So if you're interested in needing insights, just like we did the webinar, so Stephen, you can maybe talk about this, but we have subject matter experts that have lived and breathed and, worked with this data for many years. And so if you need some understanding of market dynamics or trends or where things are headed, our team does provide advisory solutions for those needs.
Yes, we're very flexible. We offer a range of solutions. You don't have to think of it as, oh, great, we're going to pay a steep fee and we're going to be hitting, this tiny nail with a sledgehammer. We're very flexible. And the last thing we want is for our clients to underutilize our data. We're here to help, and we're here to offer you the range of solutions that will help find a solution for you that's most efficient and most cost effective.
Yeah, it's funny timing. We actually just had a client today reach out and give a shout out for your fixed rate CMBS loan analysis from last week, Stephen. And he said, this was the exact information that my team and I spoke about on an internal meeting yesterday, and he wanted to see if you would share that breakdown. So we shared it with our client. We're even willing to break it out by property type or geographic region. So reach out to Trepp. We would love to work with you. So speaking of Trepp data, and Lonnie, you mentioned CRE CLO issuance and where we're at for the year earlier, but I wanted us to get into what we're seeing in terms of commercial mortgage-backed securities issuance so far. We just released a piece on our Q1 2025 data set, and we're seeing some positive momentum and some signs, especially in the office market, that we wanted to share.
Yeah, so if you're not thinking of Trepp as the source for issuance data, you're missing out, because we track all of the securitized deals across the spectrum. So we'll kind of run through these fairly quickly. But again, if you have specific questions, feel free to email us at podcast@trepp.com. So we break it down: 42 domestic private label CMBS deals with an outstanding balance of $32.74 billion were issued during the first quarter of 2026. So this marks the second busiest first quarter since the GFC. Now, that's super exciting, and we're optimistic what that means for us in 2026. But if you compare it to last year, it's about a 12.8% reduction from the first quarter of last year, which was the busiest first quarter post-GFC. So I think our predictions, Stephen, of exceeding issuance in 2026 are maybe teetering at this point because we saw a pretty drastic pullback from what we saw in the first quarter last year.
Yeah, I'm not feeling super confident about that number right now. But on the flip side, I mean, if we bring in CRE CLO volume as well, it's still looking pretty good. I gotta say, when you combine this all together, this does put us on a very good track. And yeah, if you look at the annualized volume across both private label CMBS, so that's conduit, SASB, large loan, and then you add in CRE CLO as well, we're on track to hit roughly 150 billion, which is just shy of our banner 2021 year. We hit a total combined 163.7 billion in that year. What's interesting, though, is the conduit sector has actually been the laggard here. Conduit is the weakest of the four sectors so far in 2026, but honestly, it's still early in April, and so all of that could change dramatically. It's too early to get, too bullish or too bearish here.
Yeah, I think there's still promise for 2026. We've had a lot of stuff happen in the first quarter, and despite that, the issuance numbers have still been impressive. If you break it out by SASB, so we talked a lot about SASB over the last year or so, just because the percentage of deals that have been SASB has been astronomical. And, as we've said, it's increasingly taking on a larger proportion. So we've seen about 32 deals to the tune of 24.54 billion worth of SASB issuance. There were 6 SASB deals at over $1 billion each. And I'm hopeful that we're going to have some research coming out here shortly that kind of highlights some of those large transactions. To give you a little bit behind the scenes, there was one deal that was at 3.05 billion worth of origination. Pretty interesting. If you look at the CRE CLOs, which we talked about earlier, and Stephen, you added into the total there, 16 CRE CLOs have come to market in the first quarter, outstanding balance in aggregate at 14.5 billion. So as you mentioned, while the conduits pulled back about 12%, CRE CLOs were up 76% from the same time period last year. So again, maybe just a rotation of where the deals are flowing, but still really positive first quarter, and maybe something that doesn't get enough attention, at least right now. I think the momentum is shifting here. It feels like office optimism is starting to come back at a scale that we haven't seen in some time, 5, 6, 7 years. CMBS lenders are getting more comfortable with writing office loans. So on the 10 conduit deals that were priced in the first quarter, 18.7% exposure to office. That was up from 16.32% during the same period a year ago, and 15.75% when you look at the full 2025 year. So there were 44 total conduits issued in 2025 with office exposure at 15.75%. In the first quarter of last year, there was 16.32% office concentration. In the first quarter of this year, 18.7%. And I think if we go back and take a longer historical look, Stephen, you would see office concentration generally was about 25%. So we're not too far off the long-term average here.
That's right. All it takes is a couple, trophy deals that bond investors can, really get behind and support, and you hit that number pretty easily.
Now, I don't know if you saw some of the multifamily numbers here, but concentration of apartment loans shrunk pretty sharply to 14% from 21.1% a year ago, and full concentration of 23.25%. So I don't think that's atypical, Stephen, given where we are in the cycle for apartments. And again, this is looking at CMBS issuance for apartments. These are deals that probably didn't qualify for Fannie or Freddie in the first place, generally not quite the same level of quality in terms of financial performance. But it feels like office is taking some of that share back.
It is. And I don't know, how much of this is balancing the risk scales, but if you look at the underwritten credit metrics, I think this speaks to ultimately what it takes to bring deals to market. Sometimes if you have exposures that maybe bond investors will be a little bit hesitant about. So if you look at the average LTV for the 10 conduit deals that priced during the latest quarter, it was 57.6, up from 57.1 a year ago. Not a huge change. The more telling metrics are the debt service coverage ratio, or DSCR, and debt yields. DSCR increased to 1.99 times from 1.76, and debt yield climbed to 13.3% from 12.5. Those are some pretty noticeable increases.
Yeah, I think it highlights some pretty strong performance here at the property level and without seeing significant changes in the leverage points. And so this actually, if you look at everything that happened in the first quarter, all the talk track, everything we do every week in the intro, and you just reduce it down to the numbers, feels pretty strong.
Sure does.
The business decisions you make today define the results you see tomorrow. Your organization deserves more than advice. It deserves strategic guidance from a fully invested team. As a leading global advisory firm, EisnerAmper tailored solutions that drive growth, mitigate risks, and navigate transactions across assurance, tax, advisory, outsourcing, and wealth management. Backed by innovative technology and a compliance-driven mindset, we help you move confidently at every step. Get ready for what's next at EisnerAmper.com. So let's stick on the topic of CMBS, but maybe talk about the other side of CMBS performance. We wanted to do an appraisal reduction trigger 101 today and walk through what happens when a CMBS loan is believed to be backed by collateral worth less than it once was.
Yes, so this is a really novel concept, at least relative to our residential mortgage-backed security equivalents. Both in RMBS and CMBS, you know the value of collateral at securitization when the loan was originated, right? You get an independent third-party appraisal that validates the worth of the collateral. Now, with RMBS, you're kind of blind to that value going forward, even if the loan becomes distressed. Say if the borrower defaults and the lender is going to have to foreclose, or the servicer. Now, with CMBS, that's not the case. You can actually get an appraisal reduction. You get an updated valuation, which is really, really important and informative for bond investors. So an appraisal reduction is a servicing adjustment that's made when a troubled CMBS loan is believed to be backed by collateral that's worth less than it once was. In practice, it usually follows a new appraisal or valuation update showing the property's value has declined. And the purpose is to protect the bond trust from advancing too much cash against a weakened asset. If a loan looks impaired, the appraisal reduction can actually reduce the amount of interest that gets advanced to bondholders. It's a really important differentiation relative to RMBS, where you don't have that same reduction in interest advanced. So for market participants, appraisal reductions are an important early warning signal. They often indicate that a property is under stress, that losses are becoming more likely, and that the loan may be headed toward a workout, modification, or liquidation. In other words, an appraisal reduction does not guarantee a loss, but it tells the market that the deal's view of the collateral has worsened materially. Now, because a new valuation can have real implications for bondholders and how a troubled loan is managed, the pooling and servicing agreement, also called the PSA, lays out specific events that trigger when a reappraisal happens. And those are the main triggers we're about to walk through. So, what triggers a reappraisal event? Well, if a loan payment default has lasted 90 days or more, a new appraisal gets ordered. If the borrower files for bankruptcy, a new appraisal gets ordered. If a receiver is appointed for the property or for the loan, if a borrower is pushed into involuntary bankruptcy and the case is not dismissed within 60 days. If the property becomes REO, real estate owned, that means it's been taken back by the lender or the special servicer. And then finally, at maturity, if the loan cannot be refinanced cleanly, a reappraisal may be triggered. So in other words, when we're getting all of these maturity defaults, if the borrower says to the lender, hey, I have a loan commitment in hand, here's proof of it, I think I can get this refi done in the next 60 days, the servicer isn't going to waste money and order an appraisal. But if the borrower says, look, I don't have any promising prospects to refinance this loan, I'm really looking for a modification here, that's when the reappraisal event gets triggered, and the special servicer will then order that new appraisal.
So if you are a user of the Trepp CRE products, you know that you can set triggers in our system to get alerted anytime a property is reappraised. So we've short-circuited that process for our clients to actually get real-time access to those reappraisal values. And so it's interesting when we do these one-on-ones, Stephen, it sometimes feels like in the market that these things are kind of done on a whim, when in reality, these things are just come back to the covenants. Like it always comes back to the covenants. And we have the pooling and servicing agreements available for these deals as well. I would say today, right, we're probably seeing most reappraisal triggers from a loan going into default for 90 days or longer or maturity default.
Yeah, absolutely. by far the two most common trigger events. And what's funny is if you follow TreppWire closely and our credit story timelines closely, you'll hear us talk about the maturity default or the special servicing transfer. And then it's usually about 3 to 6 months later, then you'll see the reappraisal story come through. It's been a very predictable information flow for these loans. So, oftentimes you'll see 2 TreppWire credit stories within a 6-month time span for these matured loans.
Yeah, and that's another feature we have in the tool is you can actually see anytime we mention the property in TreppWire. So to your point, it's kind of funny to go back and you see, a credit story that says appraisal value slashed by 80%. And to your point, you click into the property and you see, well, we wrote about this 3 different times over the last year. It's been in and out of delinquency and got transferred to special servicing. And so, we definitely feel like that's something that provides additional value for our clients that you're probably not getting everywhere else.
Some not so subtle Trepp plugs, but you know what? This is a Trepp podcast, and sometimes people forget that. They come to us and they say, I love your show, so much great free CRE information, but a lot of you guys have become clients or are loyal clients as well. So we do have a lot of data and offerings, and we will talk about them from time to time. So great shout outs. Reach out to us if you need anything. And I'll move us along now to a few other CRE headlines we wanted to talk about this week in our deals and data segment. In the office market, there was a story in Commercial Observer this week about Empire State Realty Trust entering a contract to sell its 26-story office building at 250 West 57th Street to Namdar Realty Group for roughly $280 million.
Yes, this 540,000 square foot building is along Billionaires Row in Midtown Manhattan and is currently 84% leased, according to The Real Deal, which first reported this news. The apparel retailer TJ Maxx anchors the retail portion of the building, while corporate tenants include commercial real estate platform Hanover Street Capital and music recording and publishing company Concord Music Group. Led by Igal Namdar, Namdar Realty will acquire the Midtown building at a bit of a discount from what ESRT originally asked for when it put the building up for sale in February at an asking price of $350 million. Namdar is set to buy the property along with frequent partner Empire Capital, according to The Real Deal. ESRT has been in possession of the full block building between 8th Avenue and Broadway since before the firm's October 2013 IPO. The company has invested $140 million in capital improvements to the building since then, according to The Real Deal. Spokespeople for ESRT and Namdar did not immediately respond to Commercial Observer's requests for comment. The sale was brokered by Newmark, and Newmark declined also to comment on the sale. So, Lonnie, that's a significant amount of capital improvements, $140 million. Yikes.
That's more than just inflationary pressure, Stephen. They've had to do quite a bit there. I did pull a pretty quick report on Namdar because this one jumped out at me a little bit because they're known, as you know, Stephen, as being an opportunistic acquisitions shop for underperforming Class B and C regional malls, and they pretty much have purchased things in small to mid-sized markets. And generally they're buying stuff for pennies on the dollar. The firm was founded in 1999, and if you look at their website, it says that they have over 70 million square feet of commercial real estate nationwide, and retail assets dominate the portfolio. They do own office, multifamily, mixed use, and healthcare properties. Just typically, when you see a headline with Namdar, it's not for an office acquisition, and it's certainly not for an office acquisition in New York City. So, look, this one's got some details that we don't have. I'm with you. The $140 million in CapEx seems really high, especially on a $280 million purchase price. But we'll see. Maybe Namdar has something up their sleeve with this one.
I mean, in fairness, TJ Maxx is the retail anchor there. So, maybe there's something there that is in their core wheelhouse, and they say, well, let's just build on top of that.
Yeah, I think that's probably, they like the tenant. They probably have relationships with TJ Maxx and some of their other centers. I think that's a valid point there for sure.
All right, and moving over to Los Angeles, we don't have all the details on this lease yet, but we saw that the official hospitality provider for the 2028 Summer Olympics has signed Southern California's biggest office lease so far this year.
Yes, On Location, which fulfilled the same role for the 2024 Summer Olympics in Paris and the 2026 Winter Olympics in Italy, signed for just over 108,000 square feet at the 40-story Union Bank Plaza. It's a little bit more than 15% of the rentable space at 445 South Figueroa Street.
I wonder what the economic impact on some of these things are going to be, Stephen. I know we have the Summer Olympics coming to the U.S. in 2028. You have the World Cup that's being hosted in the U.S. this year. There's a lot of these external events that should drive some significant positive economic impacts for those markets.
Oh, absolutely. It's always fun to see exactly how much activity gets spun up from these, major international events.
It does feel, though, like the Olympics in particular, the Winter Olympics this year, maybe we have too much availability or real-time news, but when I was a kid, the Olympics were like must-watch TV. And if I'm being honest, like I don't think I really watched anything start to finish this year on the Winter Olympics.
Yeah, I mean, I caught a little bit of my favorite sport, curling, but, so many of the athletes, I mean, I don't know if it was so many, but you had some major injuries, which I think definitely hurt a little bit on ratings, when you have some of the folks that gather the most headlines getting injured. And I don't know, I think there's a real negative knock-on effect there.
I do remember as a kid, though, the Olympics were something special, and it just lost a little bit of its luster. And even the parts that I did watch, it's like it's been such a production now. Like they have all of the media with like all these skits and specials, and they're trying to make it like interactive and entertaining versus just like covering the games. It's kind of changed the dynamic some. But the Summer Olympics, hopefully I'll catch some, because I definitely, with track and field in particular, those being such individual events, I really like watching those and seeing how our athletes compete.
Yeah, I mean, I was really bummed with Lindsey Vonn crashing out, like absolutely gruesome knee injury. Like that was going to be a fantastic story, battling back, and then the details of that injury were gruesome, like almost losing her leg. That's terrible. But I mean, she's the GOAT of women's Super G downhill skiing. She's a beast.
So, turning to retail, maybe we can talk about the buying Olympics or the buying binge that Bed Bath & Beyond has been on. The first headline here is that Bed Bath & Beyond is buying Lumber Liquidators' parent company.
Yes, the publicly traded company said it's under a preliminary agreement to buy F9 Brands Incorporated, which owns and operates Cabinets to Go, Lumber Liquidators, Gracious Home / Thomas Baker, and Southwind Building Products. The buyer said the purchase price equates to nearly $150 million, including $37 million in cash and $16 million in shares, which equates to $107 million. Bed Bath & Beyond, which trades as BBBY, owns retailers Bed Bath & Beyond, Kirkland, Overstock, and Bye Bye Baby. The new F9 brands, along with Alpha and Closet Works, which BBBY is absorbing through its Container Store acquisition, would be part of the company's Beyond Home Services arm. The release also said the acquisition will help position the company to increase transaction sizes and margins and customer lifetime value. Lumber Liquidators has more than 200 stores across the U.S., and Cabinets to Go has over 100, while they will continue to operate their own retail stores. Their products will also be showcased at the Container Store and Bed Bath & Beyond stores, the release said. So this is a really interesting one, Lonnie. Like, if you think about the world in which we live and kind of the appeal of do-it-yourself renovations in today's world of higher price levels, and also the wealth of knowledge that's even more at our fingertips with AI. This is an interesting integration.
Look, they've gone from selling pillows and sheets to lumber. But I do think it makes sense. Everyone wants to be part of a, vertically integrated or full life cycle type of experience. And if they can effectively, be part of that, as they said here, from full life cycle of renovation all under one platform, it makes sense. I've actually used Cabinets to Go in some rental properties and had clients use them and actually offer a really nice product at an affordable price, nice service. Lumber Liquidators has had a pretty long-standing run in the marketplace. And so, I think this could be a good reposition kind of strategy for them. It's still weird when you hear Bed Bath & Beyond. I immediately think of the 20% off coupons that would come in the mail like incessantly. And it's been a very long time since I've even heard the store Bye Bye Baby. But, I've seen quite a bit of activity on Kirkland's too. they've actually gone away from some of their smaller storefront services and moved into larger footprint storefronts. So I'm rooting for them. I mean, that Marcus Lemonis, he's pretty notable. I think he also manages or owns Camping World and a few other businesses, pretty active on social media. Love to have him on the podcast. It'd be really great to get his interpretation of where things are in the market today. So if anyone knows him, send him a shout out and let's get him on the show.
Yeah, because with this acquisition, it almost feels like they're trying to tackle an IKEA-like business strategy.
Yeah, which, listen, IKEA has grown very rapidly across the U.S., despite having to assemble everything at home when you get there.
Did you know that there's actually a competition, I believe, like a speed assembly competition?
Yeah, I would not qualify for that. But
I'm pretty good at building IKEA furniture, actually. So maybe I'll join. We'll see.
They actually they have services now where people come and they just assemble the IKEA stuff. It's I would laugh. I used to live near an IKEA, and I mean those stores are so massive. You could just get lost in them. It's pretty incredible. But yeah, it'll be interesting, Stephen, if they're able to execute on this. I think assembling the parts is one thing. Executing on the strategy is something different. I'm optimistic they can do it, but they're pulling quite a few things together here.
So we'll close with some programming notes. We've mentioned a lot of Trepp reports and data today, but we had another report out this week, our special servicing report, and we found that the CMBS special servicing rate rose again in March, and the increase was driven mainly by 6 large office loans. So if you're interested in seeing the overall rate and the breakdown by property types, reach out to us at podcast@trepp.com or find the latest report on our website. And we are officially 1 month away, or less than a month now, from Trepp Connect, which is crazy. If you're new here or you need a reminder, Trepp Connect is our annual CRE and capital markets conference taking place in New York City, right in Rockefeller Center. We'll be hosting this conference on May 6th and 7th. We have a really robust agenda. Scott Reckler will be our keynote speaker. Lonnie will be hosting a fireside chat with Bill Sexton, the CEO of Trimont. Stephen is leading several panels on data centers, dislocation and deployment, and several of our other Trepp experts are going to be talking about the lending reset, AI in commercial real estate, risk, and the bifurcation across property types. So we're really excited about all the robust content and material that's going to be presented at this conference and all the networking opportunities. This is not your typical trade show. It's a much more intimate conference, about 200 senior leaders across commercial real estate and capital markets. So we still have some tickets available, but don't wait too long because seats will fill up quickly. We'd love to have you there. We have so many of our podcast listeners who've reached out and are already joining us, but if you haven't yet, send us a note. We're happy to send you extra details and make sure that you can get a ticket to join us. And turning to some shout outs. So thanks to James B for reaching out. He said he really appreciates our work and finds the podcast to be one of the most interesting and informative out there. And it's definitely most fitting to our niche corner of the CRE world. So thank you for the kind words, James. RES gave us some comments on our CMBS defeasance report. Michael B said he's excited to join us at Trepp Connect this year. Susan T is building out a lot of new AI tools and wants to find ways to integrate Trepp data in them. So we are looking forward to showcasing that to you on a call. Scott B said he's really excited to hear our keynote session with Scott Reckler at Trepp Connect. And we also had inbounds this week from William C, Derek D, Ken S, Sarah B, Edith F, and Philip D. So thank you to everyone who reaches out. I think Lonnie and Stephen, I probably need to do an audit of your LinkedIn pages because I'm not sure you answer all the DMs that you get. So if you've emailed or reached out to Lonnie and Stephen and they haven't answered, don't take it personally. I will go and make sure that they get back to you. But thanks to all our listeners as always. With that, we'll close. Thanks to our producer, Carly Cento. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.